The stock market is in a bubble and gold rising to $4,000 an ounce. The stock market is in a bubble, but the bubble is likely to get bigger. The target for the S&P 500 is about 3,800 points. Investors are asking me how high can this stock market go. The July employment report, released Friday, is providing a relief for the stock market. Non-farm payrolls came at 1.46 million. Normally I compare economic data with the consensus forecast. In this case the forecasts were all over the place. The key point is that optimists have proven to be right. President Trump has banned TikTok and WeChat. In a normal market, this would be bad news for the stock market. However, in this market, bad news is good news. The momentum crowd is excited about Facebook FB, plus 1.19% replacing TikTok. The enthusiasm has caused a rip-roaring rally in Facebook stock. At the same time, the Momo crowd is excited about Microsoft MSFT, minus 1.78% buying TikTok. It does not occur to the Momo crowd that if Microsoft ends up buying TikTok, it will be a much stronger competitor to Facebook than TikTok ever was. How about retaliation from China? Apple AAPL, minus 2.27% is in the crosshairs. What does the Momo crowd do about this higher risk in Apple stock? They are oblivious, buying Apple stock on the momentum. There are many crosscurrents. Let's explore the key question of how high the market can go with the help of a chart. Note the following: a chasm is developing between what stock market analysts say and what they know. To save their careers, analysts have no choice but to follow the Momo crowd in the stock market. These days analysts' calls have often become a case of the tail wagging the dog. Human nature as it is, anything can be justified. Being independent, I have been able to call a spade a spade. The stock market is in a bubble, but the bubble is likely to get bigger. This call is based on macro and fundamentals. Under these circumstances, technical analysis is invaluable. The chart shows the measured target for the S&P 500 is about 3,800 points. The measured target is produced by excluding the time period encased in a red rectangle on the chart. The reason for excluding this is because this period is characterized by the one-time abnormal occurrence of the coronavirus. If the period shown by the red rectangle is not excluded, the measured target would be much higher. The chart shows that the Aurora report correctly called that the virus would hurt stocks prior to the decline in the stock market. Please see how the coronavirus scare has driven dangerous arrogance and greed in the stock market. Buy zones are powerful. They often give investors opportunities to buy good stocks and ETFs at great prices. The chart shows that many stocks and ETFs fell into Aurora buy zones during the market swoon. For example, Apple could have been bought as low as $212.61 in the Aurora buy zone, and is trading at $452.96 as of this writing. Microsoft could have been bought as low as $132.52 in the Aurora buy zone, and it is trading at $215.07 as of this writing. The chart shows that RSI, Relative Strength Index, is overbought but has room to go higher. It is important to note that the Nasdaq 100 NDX, minus 1.13%, represented by the Invesco QQQ Trust QQQ, minus 1.15%, has significantly overperformed relative to the S&P 500 and Dow Jones Industrial Average DJIA, plus 0.17%. This is due to the heavy weighting of 5 mega-cap tech stocks: Apple, Microsoft, Amazon AMZN, minus 1.78%, Facebook and Alphabet Goog, minus 0.37%, Google, minus 0.43%. Big institutions are hiding in the presumed safety of those stocks. Watch them closely for clues for what is next in the stock market. Consider watching popular Momo stocks such as Fastly FSLY, minus 11.50%, and Datadog DDOG, minus 16.36%. The Momo crowd ran them up to unrealistic heights prior to their earnings reports this week and is now suffering massive losses. Opportunities abound. A lot of money is to be made in an environment like this. Consider using the concept of protection bands to protect your long-term portfolios. In addition, consider opportunistically taking advantage of short to medium-term opportunities as they arise. As a note of caution, the risk is much higher than generally believed. It is important to be nimble, have access to proven, independent sources and have risk control measures in place. Consider buying a proper allocation of gold as an insurance policy. However, gold is very overbought in the short term and vulnerable to a pullback. The two gold ETFs to consider are SPDR Gold Shares GLD, minus 1.58% and iShares Gold Trust IAU, minus 1.72%, depending on a set of specific criteria. To learn more, please read Stock Market Bulls Should Consider Owning Gold as an Insurance Policy. Gold rising to $4,000 an ounce would not be an unreasonable move, fund manager says. Michael Cugino of the Permanent Portfolio makes the case that gold is still relatively cheap, despite its 35% increase this year. Stocks and bonds may be in an asset bubble, as record low interest rates and a tremendous increase in the money supply have sent prices soaring this year. Add gold, which has risen 35% to $2,049 an ounce August 5, to the list. But Michael Cugino, CEO of the Permanent Portfolio family of funds, says gold can move a lot higher. It would not be an unreasonable move for gold to breach $4,000, he said in an interview. Cugino manages the Permanent Portfolio PRPFX, minus 0.67%, a $1.9 billion mutual fund that is conservatively run and rated 4 stars by Morningstar in the fund research firm's U.S. fund allocation 30% to 50% equity category. A long wait for a big move first. Take a look at this chart showing how monthly prices for an ounce of gold GCOO plus 0.89% per continuous gold contracts on the New York Mercantile Exchange have moved over the past 30 years. You can see the triple bottom from the end of 2015 through November 2018. Ever since then, it has been gradual move up, then some down. It moves sometimes in big chunks, gives some back, sits around and does nothing, reacts to stimulus, inflation, the value of dollar and euro. But it has had an aggressive move this year, Cugino said. Gold may extend gains as money is being pumped into the U.S. economy, the dollar is declining, and investors are fearful that inflation may return, he said. Cugino warned of sharp pullbacks even during a long-term move up, as did Nigam Arora, who wrote that gold is an appropriate hedge against stocks. Still, gold is a very small market, and it can be easily manipulated by the governments, Arora wrote on MarketWatch. The case for gold being relatively cheap when looking back at how gold and stock prices have moved over the very long term, Cugino said gold is still trading at an inexpensive level when compared with stocks. This chart shows monthly prices of gold divided by closing levels for the S&P 500 index SPX, plus 0.06% over the past 30 years. The S&P 500 was up 3% for 2020 through August 5, but it was also up 49% from its closing low March 23. Despite that action, and this year's 35% climb for gold, the metal was trading at 0.6 times the level of the S&P 500. It hasn't been above 0.7 since 2014, and you can see looking further back that it was close to 1.7 times the S&P 500 in August 2011. Different crisis, different response, Cugino said. The quick and tremendous reaction to the COVID-19 pandemic by the federal government and the Federal Reserve was completely different from the actions taken during and after the 2008 credit crisis. In 2008, the fiscal policies didn't matter much for economic gain. GDP didn't grow because of stimuli. Monetary assistance from the Fed basically stayed in the banking system, he said. But now, because of programs meant to help small business, the payments made to individuals and families through the CARES Act and the loan payment deferral programs, stimulus is much more targeted to get money out to consumers, Cugino said. This points to a long-term concern and bullish possibilities for gold. Even though we have deflation now, eventually, with excess raw materials, in a growing economy, the velocity of all that money can produce inflation risk, he concluded. Permanent Portfolio. The Permanent Portfolio PRPFX, minus 0.67% is designed to provide good long-term performance regardless of the economic environment, and to complement, and partially hedge, a broad portfolio by bouncing back more quickly during periods of market turmoil. Gold and silver made up more than 27% of the portfolio. Equities made up about 21%, with top holdings in that bucket including Texas Pacific Land Trust TPL, plus 1.23%, Freeport-McMoRan Inc. FCX, minus 4.12%, Facebook Inc. FB, plus 1.19% and Twilio Inc. TWLO, minus 4.41%. So the fund cannot be expected to outperform the S&P 500 over long periods. But because it bounces back more quickly, and because of the nature of the portfolio, it has outperformed the index so far this year. From a closing peak Feb. 21 through its trough March 20, the fund was down 21%. From its record closing high February 19 through its closing low March 23, the S&P 500 was down 34%. So the fund didn't capture the S&P 500's extraordinary gains, led by the large tech companies that make up a major portion of its market capitalization. But if you go back 20 years, its average return has beaten that of the index.